Hello and welcome. It's time to take a look ahead at what could drive the markets this week. I'm Kelly O'Byrne and I'm a dealer here on LCG's trading desk. Well, we are in the thick of corporate earnings season. It's the second quarter results in the US and plenty of half-year updates coming through in Europe and the UK. The overall tone of these results will help determine whether the current bull run in equities gets another leg higher. Some earnings highlights for next week include HSBC on Monday, Apple, BP and British gas owner Centrica on Tuesday, Rio Tinto, Stan Chart and William Hill on Wednesday, Adidas and BMW on Thursday and finally RBS on Friday. And all of these are available to trade on the LCG platform. There's also plenty of economic data to sink your teeth into if you are trading the forex market. The RBA rate decision comes after a big breakout in the Aussie dollar. However, weaker than expected inflation last week has tempered some bullish bets. Eurodollar broke above 117 to hit a 2.5-year high last week. So Eurozone CPI on Monday, as well as second quarter GDP on Tuesday, will be key. It's also, of course, the Bank of England's turn to set interest rates in the aftermath of a modest bounce back in UK GDP last week. Also on tap, we have PMIs from Europe, the UK, the US and China, which could have a bearing on the 2-year high in copper. Now, I'm joined by our Head of Research, Jasper Lawler. Jasper, very welcome back to you. So back to earnings season. How do you see things going and how important is it for the health of the stock market?
Thanks, Kelly. I'm glad to be back. At the moment, it's paramount. I mean, I think that's really the key force in the equity markets is that earnings season is going so well. In the US and in the UK and Europe to some extent, it's largely the bounce back in the energy sector. We had results from Shell last week, and by one measure, profits were up 245%. So that large weighting of energy is really helping. But we're seeing it, kind of across the board. Technology, huge results from Facebook again. All of this is just a positive impetus onto the stock market. But is that the be-all and end-all of why we're moving higher in stock markets? No. Obviously, every week, pretty much, we talk about the fact that it's very easy central bank conditions, and really that is behind the bull market. That will probably be what ends it. But at the moment, I think we're getting another little push, particularly in the US stock markets, thanks to the strong earnings. And then from what we've seen so far in the UK, if we see a continuation of it, I think we can actually see the FTSE catch up as well.
And a few economic data points this week, and we had the Fed decision last week, of course. Where do you see the FX markets moving?
Well, you're right to say that it's probably going to be all in the context of last week's Fed meeting. But I think we do have to switch gears to the other central banks. So the RBA up first, but then the Bank of England. For the RBA, we hit the 80 level in the Aussie against the dollar. That's a big round number, probably profit taking place there. We also had Governor Stevens saying a softer Aussie dollar would be better. And obviously that inflation data that you mentioned, all kind of weighing on it a bit, but not much. And to me, the Aussie dollar's broken out. So of course we can have some correction in the meantime. But to me, whatever results from this meeting, I think it's going to be coloured by a general trend now that we're seeing in reaction to central bank meetings where actually investors are not really taking what they're saying at face value. And so even if they try and talk down the Aussie again, which inevitably they'll do, I still think the Aussie's got some legs here. And again, similar idea with the Bank of England. I think they're going to do their best to talk down the pound and suggest that there won't be any rate rises on the cards. That's certainly Mark Carney's view. I suspect that the voting will be still configured sort of 5-3 in favour of the doves. But nonetheless, the Brexit political situation is not looking as dire as it could be. Politics in Europe in general is improving. And on the flip side, it looks like the Fed probably aren't going to raise rates in September based on last week's meeting. So all of that, to me, is contributing towards the pound steadily moving beyond that 130 level. Slightly different against the euro, but I think still the pound in general can weather this Bank of England meeting.
Okay, so you've mentioned central banks. What about the big day on Friday?
Of course, we can't forget the non-farm payrolls, and I should mention actually that we've got a special live non-farm payrolls webinar taking place then with yours truly. So please attend that if you can. It's going to be the sort of 10 minutes before and after the main event. So that's 1:30 p.m. London time. And so, you know, obviously, again, that's in the context of the Fed meeting. I think probably it's going to have to be a very dramatic number, a very dramatically positive number to bring on a September rate hike, and a dramatically negative number to mean that people still don't think there'll be any more rate hikes this year, or maybe they even delay the shrinking of the balance sheet. So in a sense, it's going to probably be a short-term phenomenon. What's bad? What's really bad? Probably below 100k. What's really good? Above 300k, pretty much. And I think that's been a pretty consistent benchmark for the last couple of years.
Yeah. And quickly before we go, what's catching your eye in commodities?
Well, obviously oil has just bounced back massively. That 45 level in Brent pretty much called the bottom spot on. We had a few jokes back and forth about whether it could potentially be the bottom, crystal balls, etc. It was, and we've really moved higher pretty much ever since. I think the oil market's in a kind of range now. It's got a slight negative bent, but I think probably during the summer months, US driving season, interventions from OPEC verbally more than actually doing anything will be enough probably to keep us higher and prevent any kind of major sell-off in oil. I'm still slightly dubious on it. I think there might be a chance to sell this bounce coming up fairly soon. And in gold, it's that 1260 pivot level again that seems to have kind of sent the price lower. But if the dollar kind of keeps weakening, September doesn't look like such an option, that will be positive for gold. The only tricky thing with gold really is, both relating to the Fed, is that on the one hand you've got them seemingly more hesitant on the rate hikes. That's sending the dollar lower. But on the other hand, they're getting a bit more aggressive about the balance sheet. So if quantitative tightening, if you like, is coming on board, that's a negative for gold. So gold broke through its previous low on the daily chart, and I think probably that is indicative of the fact that we're not going to really get massively beyond 1300 anytime soon.
Thank you, Jasper, and thank you for watching. Don't forget to follow us on YouTube, Twitter and Facebook.